Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about how to avoid unexpected tax bills in retirement. And so as you transition from collecting a paycheck at your employer to paying yourself from different income streams, whether it's CPP, OAS, a pension plan, a RRIF, whatever it is, collecting one income stream versus multiple income streams can create a bit of a tax issue. So we're going to walk through that in this video. If you haven't already subscribed to our channel, hit the subscribe button below. It takes 1 second. It costs you nothing. We really do appreciate it. And join our channel. We release 2 to 3 videos every single week around financial, retirement, estate, and tax planning for Canadians. So whether you're located in Canada or abroad, these videos are for you. And we really focus them on kind of the pre-retiree to retiree market. You know, tax planning strategies that we use with our clients for the past 16 years that have made a great difference in their retirement life. So we want to pass these tips to you guys. You know, hopefully you can implement a lot of these and it can change your retirement plan moving forward. So in this video on how to avoid unexpected tax bills in retirement, we want to go through 3 different things. We want to go through tax planning. So we're going to break down some tax planning strategies and how this works. And there's multiple parts of tax planning in retirement. So we're going to go through that. We're going to go through withholding tax. What is withholding tax? How does it work? How to structure it? And there's a difference between an RSP and a RRIF. Many of you think you understand what withholding tax is, but most of you probably don't know what it is, how it works, the structure of it. So we're going to break that down. And the third part, and I think this is the most important part, is planning with multiple income streams. And this is where a lot of you get caught, especially in the first few years of retirement, with a large tax bill at tax time. And then lastly, we're going to give you some tips and tricks that we roll out for our clients that will really help you enter into retirement to make sure that when tax time comes, you don't have a large unexpected tax bill. So let's jump into tax planning. So when we look at tax planning, step 1 is to actually create a plan, right? So to break down all your assets, where you're going to draw your income from, make sure you level off that tax bill. When we put together financial plans for people, we deliver a plan almost every day in our office right now. And the main focus is obviously maximize income, minimize taxes, but also leveling out that tax bill. So we look at your average tax rate or effective tax rate in retirement, and we want that to be as level as possible right through retirement. Okay, so that's kind of part 1 of tax planning in retirement, making sure we're paying the least amount of tax now while we're alive in retirement, and also looking at estate planning, right? Like how much tax would I pay if I died at 75 or 80 or 85 or 90? What does that look like? How do we structure that and make sure that the most money comes to us or to family, friends, charities, whatever, and the least amount to the government? That's tax planning. The second part of tax planning is actually planning to pay the tax. Okay, so as I said, as you enter into retirement, things are a bit different. So what you want to do is map out your income, where it's going to come from, and make sure that you have a proper withholding tax, prepaid taxes, or at least plan to pay the tax. So when March, April come and you get your tax bill, you know how much is coming. Okay, so when we put a plan together for a client, we can show them line by line item where your income stream comes from, and also to the dollar how much tax they're going to pay that year, right? So they're prepared for that, whether they want to do it with withholding tax or prepaying the taxes, or come tax time, it's not an unexpected tax bill because they've planned ahead for that. Okay, so 2 parts to tax planning: the actual planning of it, making sure you're taking income from the proper sources, that kind of stuff. The second part of it is knowing how much you're actually going to owe, so that when tax time comes, if you're going to owe money, get a refund, and you're not going to be surprised by it. Okay, so let's jump into withholding tax now. Now, withholding tax is not an additional tax, a penalty tax, and that's where a lot of you kind of fall into. You think, well, if I pull money out of my RRSP, there's a withholding tax. So that withholding tax is a penalty, and I lose that money. Not the case at all. What withholding tax is basically a source deduction. Think of it as right now you're working, you're collecting a paycheck. When you get your paycheck, your tax is already withheld. Okay, so your employer, there's a calculation that CRA gives your employer that says, look, Jim is making $60,000 a year, and based on that salary, every paycheck that you do, as an employer, you need to take off X amount for tax, because that's roughly the amount of tax he's going to have to pay, so that when tax time comes, you fill out your taxes, you say, I made $60,000, I've prepaid X amount in tax, and you'll hopefully nothing or maybe a bit of a refund. But when it comes to RSP withdrawal, there's something called withholding tax. And all that is CRA is just making you prepay some of the tax that you're going to have to pay. Okay, so if you pull out some money out of your RSP, there's going to be either 10, 20, or 30% withholding tax. In Quebec, it's a little bit different. We'll go through those numbers in a second. But there is withholding tax. And all that is because when you pull money out of your RSP, that money is added to your income in the year that you take it out. Okay, so let's take the same example. There's $60,000 of income already. And let's say he decides to take out $10,000 from his RSP. Okay, that $10,000 is added to his income. He's now made $70,000. But when he goes to pull out that $10,000, there's going to be withholding tax of 20%. Again, not a penalty. It's basically a source deduction tax, okay? So, when he gets the money, he's only going to receive $8,000, okay? $10,000 minus 20%, he's going to receive his $8,000, and he's going to get a credit for $2,000 of taxes that are already prepaid. Okay, so when he does his tax return at tax time, he's going to say, I've made $70,000. His work took off some taxes. And when he did his RSP, it took off $2,000. Okay, so that's going to add his income. It's going to add how much tax he's paid. And then there might be a bit of a balance owing or a bit of a refund. So that's how withholding tax works. Okay, it's not a penalty tax. It's just a source deduction tax when you take money out. So let's just quickly jump into what the withholding tax rates are. Okay, so from $0 to $5,000, if you pull up to $5,000 out of an RRSP, you're going to have a 10% withholding tax. Anything above $5,000, so $5,001 to $15,000 will be 20%. Anything $15,001 or greater will have a 30% withholding tax. And again, not a penalty tax. You're just prepaying those taxes. You may owe a bit more at tax time. You may get some of that money back at tax time, depending on what your overall income is. If you have other income streams, what that all adds up to. In Quebec, the rates are a little bit different. So the rates, there's a 16% provincial tax rate on no matter what amount you pull out. And then the federal is 5, 10, and 15 in the same bracket. So up to 5,000 is 5%, 5,001 to 15 is 10%, and then 15% above $15,001. As well as that 16% provincial tax. So works a little bit different. The numbers are pretty much the same, but it just, it's structured out a little bit differently. So let's quickly go back to the example of, let's say you're making $60,000 and you had to pull an extra $10,000 out of your RSP, you had an emergency, you had to pay a bill, whatever it is. That was your only area to grab it from, so you ended up grabbing it from. Now, let's say you're in Ontario, okay? If you make $60,000, you're in a marginal tax rate. Marginal tax rate is how much tax you pay on the next dollar that you earn. Okay, so if you're already making 60 and we have to pull out another 10,000, you're going to be taxed at your marginal tax rate. Okay, so your marginal tax rate is $60,000. It's roughly 30%, just a hair under 30%. Okay, so that means that if you pull out that extra $10,000, it's going to be taxed at your marginal tax rate at 30%. But remember, we only had withholding tax of 20%. Okay, so in theory, keeping all things simple on this video and not going into too much detail in the numbers, but if you've only had 20% withheld at tax, but you're actually going to pay 30% on that money, in theory, you're going to owe another 10% or $1,000. So if all things were equal, at tax time, you would have to pay another $1,000 in tax on that RSP withdrawal because you've only had 20% withheld at source and your marginal tax rate's 30%. So you got to make up that extra 10% at tax time. So there's some strategies that you can use as far as withholding tax. Again, anything up to $5,000 is only 10% withholding tax. Okay, so if you're looking to get money out of your RSP now for an emergency, whatever it is, and you want to put as much in your pocket, delay that tax bill, knowing that it's coming still, then look to do smaller lump sums. So instead of taking that same $10,000 at one lump sum and have 20% withholding tax, you could do two $5,000 withdrawals, okay? And they're going to hold 10% only on each one. You want to spread them out by about a week or two, just so you don't trigger 20% tax. We've seen that happen. So, do a $5,000 worth redemption from your RSP. They're going to withhold 10%. Then, a week or two later, do another $5,000. They're going to withhold 10%. Now, essentially, you've put $9,000 in your pocket versus $8,000 because they've only withheld 10% on the total amount. So that's a good strategy to get more money in your pocket now. But just be aware, be cautious that all that means is you're deferring that tax bill. So come tax time, in that scenario, you're going to owe $2,000 instead of $1,000. Again, marginal tax rate is 30%. You've now only had 10% you're going to owe 20% more. So you're going to owe roughly $2,000 at tax time. So just be prepared for that. Okay. So sometimes using some of these strategies, and we implement them for our clients where, we might do smaller chunks out of an RSP, less withholding tax. But remember, if there's already some taxable income in that year, there could be a large tax bill due. So just be very, very aware of that, and make sure that, lowering your withholding tax now doesn't mean you pay less tax. You're deferring that tax bill. So be prepared for it. Now let's talk about withholding tax on RRIF withdrawals. Okay. And so on a RRIF, you have a minimum amount that you have to take out every year. So once you convert your RSP to a RRIF, doesn't matter what age you do it at, there's going to be a minimum amount that you have to take out of your RRIF, okay? That minimum amount is still taxable income to you, but there's no withholding tax on it, okay? So let's say your minimum RRIF withdrawal in the year is $5,000. Okay, if you only take out $5,000 out of your RRIF, there will, by default, be no withholding tax on that money. That $5,000 is added to your income. So if you have many other income sources, you will be taxed on that money, but there's been no tax withheld at source. Okay, so keep that in mind. Anything above the minimum amount will have a withholding tax. Okay, so let's say your minimum's $5,000 and you take out $10,000. There's going to be a 10% withholding tax if you've taken out an additional $5,000. If you take out $12,000, you're $7,000 over your limit, which means there would be a 20% withholding tax, okay? So keep that in mind as well. And it does run for the year. So let's say, again, your minimum for the year is $5,000 and you set it up so that, let's say you're taking out $1,000 a month out of your RRIF. If you set up that automatic payment, it will withhold 20% on the additional amount every single month. So they look at it in a calendar year. So just be aware of that, but you only have withholding tax over your minimum amount. But remember, the full amount that you take out of your RRIF is taxable income. So this is where people fall into an unexpected tax bill at retirement plan. So we need to talk through how to avoid that. So now let's look at, planning for multiple income streams in retirement. And the majority, if not all of you, fall into this. You have many, you have CPP, you have OAS, you have your RRIF, you have maybe a pension plan, you have a TFSA, a non-registered account. You have all these different income sources. Some are taxed, some aren't. How does this all work? How do we make sure that there's enough taxes paid during the year so that tax time comes, I'm not hit with a large tax bill, okay? So as we just mentioned, when we take money out of a RRIF, let's say your minimum RRIF payment is $10,000 or $20,000. It might be half your income for the year, okay? If you're only taking your minimum, there's no withholding tax. That means at tax time, you're probably going to have a large tax bill. So be prepared for that. Now, there's a couple of things you can do. You can ask your financial institution to actually withhold tax at source. So even if you're taking out only your minimum amount out of your RRIF, you can ask them to withhold 10 or 20 or 30, whatever percent you want. So that's one idea. It can be a percentage or a dollar amount. So we do that for most of our clients. We'll withhold usually 20%, okay? That way we know we're holding back enough money. If you get a bit of a refund, great, but usually it falls in line with where the client is. If we have a client with a bit lower tax, we'll do 10%. So we try and plan it around what the client's overall tax bill will do. We can kind of map that out and just make sure we're withholding the right amount. So if you're only taking out the minimum amount, but you want to make sure you're having withholding tax on there, ask your financial institution. They can set it up, again, either as a percentage or a dollar amount. So when we look at multiple income streams in retirement, I want to go through like a pretty typical client, typical Canadian, I would say. So let's grab someone in Ontario, single family, doesn't really matter. But let's say this is a single income and, a spouse could have or partner could have the same amount of income. But this is a single income we're looking at for one person in Ontario. So let's say their CPP was $10,000 a year. Their OAS was $7,000 a year. They have a defined benefit plan. I know many of you do, many of you don't. That gives them $18,000 a year. And then they're pulling money out of the RRIF, their minimum amount out of the RRIF of $10,000, okay? So their overall income for the year is $45,000. Now, because they have 4 different income streams, each source is going to deduct or withhold taxes accordingly, okay? CPP, they're going to withhold 0 tax on $10,000 unless you ask them to. OAS, $0. The defined benefit pension plan is going to withhold roughly $500 to $600 in the year. So not a whole lot because they treat it as if that's the only income. Okay, so when your defined benefit plan pays you your $18,000, so $1,500 every month, they assume that that's your only income. And they say, well, based on $18,000 of income, there's pretty much no taxes due, so we're not going to withhold any tax. And this is where these multiple income streams and taxes come into consideration. Okay, and your RRIF, if 10,000 is your minimum RRIF withdrawal, again, no taxes. So 45,000 of income, you've paid roughly, let's say $500, $600 of taxes. Okay, very small amount of tax, but still a decent amount of income. This is where you run into that unexpected tax bill. Okay, so in Ontario, with 45,000 of income, you're going to pay roughly $6,000 of tax. Okay, now you've only had about $500 or $600 taken off at source. That means that you're going to be left with a tax bill of over $5,000 in retirement because you haven't planned for it. It's, again, 45 of income coming from one income stream, an employer, they're going to withdraw the tax accordingly. They're going to take about $500 a month in tax off there. But again, because you have CPP, OAS, pension plan, RRIF, all these income sources treat each one individually as a silo. But when it all comes together, it creates that tax bill, okay? So make sure that you plan ahead. You want to have, either plan and know that you have that tax bill coming and be prepared for it so it's not a shock, or have money withheld at source on your CPP, your OAS, and your RRIF, okay? And even ask your pension plan to withhold a bit more tax as well if you want, okay? There's strategies that you can use to make sure that when tax time comes, you've already prepaid the tax. Now, some of you say, hey, look, I'd rather pay a big tax bill at tax time because that means I've had the money in the meantime. Absolutely true. But the purpose of this video is to make you aware that there's going to be a tax bill at tax time. If you know it's coming, no problem. I actually like to have a tax bill at tax time. I prefer to have my money during the year and pay at tax time. Now, there's obviously some limits. Sarah's going to want some quarterly payments if you get too high, all that kind of stuff. We won't get into that in this video. But at the end of the day, I owe taxes at tax time. That's great. I've had my money in the meantime. I'll pay my taxes, but I've planned and prepared for it, okay? So this video is all about that, planning and preparing for taxes. As you transition to retirement, there's going to be a tax bill that you're not used to. Prepare for it. Make sure that you either plan for it and know that it's coming, or ask your financial institution, ask CPP and OAS to withhold around, say, 20%. For most of you, 15, 20, 25% is going to be the ballpark of your average tax rate in retirement, okay? So if you withhold, say, 15% at source, then you're prepaying some of the taxes. When tax time comes, you're going to be much better off and not have a big tax bill. So lastly, I want to run through a few tips that you can implement within your retirement plan to help lower your tax bill, avoid a large tax bill at tax time, and just even things out as best possible. And this is kind of some of the strategies we use with our clients to make sure that they're paying as little tax as possible, they're prepared for the tax, and they're kind of evening it out among the retirement. You don't want to have a large tax bill one year and zero the next year. And we actually had a call with someone a couple of weeks ago, and he said, this is my second year of retirement, and my first year of retirement, my accountant was so excited because we paid zero tax. And as they were watching my videos, they realized that's probably not a good thing, because eventually you're going to have to take money out of your taxable accounts. You want to even that out as best as possible. So, unless every year in retirement is zero tax for you, you want to level that out as best as possible. So a couple strategies. Again, I've always been a proponent. You want to build up a tax-free savings account leading up to retirement. That allows you to pull larger lump sums in retirement that are going to be tax-free, okay? So if you have an emergency, if you want to do the big trip, whatever it is, having that tax-free savings account can just give you that lump sum or even out your tax bill over time. Let's say you need $50,000 a year in income and you have a nice TFSA built up. We can use $5,000 or $10,000 a year out of your TFSA to lower the taxable income and your overall tax bill while still giving you the amount of income that you need. So that's one strategy. The second one would be, if you need to take a large amount out of an RSP or RRIF in retirement, or even before retirement, is to separate it out over 2 years. Okay, so let's say you need to take $10,000 out of your RSP for an emergency, and you're making $60,000 a year. So going back to our example earlier in the video, if you can take $5,000 out this year and defer the other $5,000 until the following year, that's going to be a good strategy, because again, you're taking that, you're leveling it and you're actually pushing some of that tax bill to a future year. You're only taking 5,000 this year, 5,000 next year. It's a cleaner way to do it, okay? So if you can do that. Again, a tax-free savings account or even a line of credit in the meantime could maybe be a buffer to kind of defer that other 5,000. So if you can defer or split up a large withdrawal out of a taxable account like an RSP or RRIF, try and do that. Now, when it comes to tax planning in retirement, there's a few things you always need to consider, okay? So, I'm younger, I have 4 young kids, I've mentioned that in this video. When I do my tax planning, I also do tax planning around kind of the peripheral stuff. And one of the big things for our family is a child tax benefit, okay? So I have 4 kids. They're 2, 4, 6, and 7. So young kids, we get a child tax benefit check, okay? But that is based on our family income. So as I look at how much money I'm going to draw to the company, what my income, my salary, or dividends, all that kind of stuff, I take into consideration the child tax benefit. Because that check, when you have 4 young kids, that check can be quite substantial. So the more money I make, the smaller that check is. So I'm able to reduce my income through RSP deposits and that kind of stuff. So again, when you look at your income tax planning, there's peripheral stuff, okay? For people entering retirement or in retirement, you have to consider now your CPP, your OAS, and your GIS, okay? So let's focus on OAS and GIS. If you start taking too much income at a time, front and load it too much, don't do proper tax planning, you could have OAS clawback or potentially lose your GIS. Now, not many of you qualify for GIS. Some of you do, obviously. But if you qualify for GIS, be very aware where you're taking money from every year, because you may bump over that threshold and lose your GIS. And it's a nice payment, so you don't want to lose that, okay? So as you do tax planning, draw money out of registered accounts, make sure you pay attention to both OAS clawback and your GIS, okay? So kind of the peripheral benefits you're receiving, you could lose some of those if you start taking out too much taxable income. Again, that's where tax-free savings comes in nicely. If you need a lump sum of money, you can take it out of the tax-free without drawing up or increasing your taxable income. So this was a bit of a longer video than what we usually do, but I really wanted to get this content out to you because it impacts 100% of you watching this video that are either entering into retirement or in retirement. And if you're a ways from retirement, it's still good to start planning and have that mental capacity to know what's going to happen when you enter retirement. So, as you enter retirement, remember, you're probably going to go from one income stream to multiple income streams. Make sure you're having either proper withholding tax, prepaying your tax, or tax at source, much like you have now when you're working. Or, do the proper planning and make sure you understand how much tax you're going to have to pay at tax time, okay? So add up all your income sources. Here's how much tax you're going to pay. Be prepared. What we don't want for any of you is to hit tax time and be hit with a large unexpected tax bill, okay? I don't mind a large tax bill if we're prepared for it, okay? So that's what this video is all about. Be prepared for it. Look at strategies to kind of lower that tax bill, even it out. Again, withholding taxes, if you're running into taking money out of an RSP or more than your RRIF minimum, there's going to be withholding taxes. These are not penalty taxes or additional taxes. They are CRA withholding money at source. So you're just prepaying some of the tax you're going to have to pay eventually anyway. You may get some of that back. You may owe a bit more. So just understand that. And again, make sure you do proper tax planning. As you enter retirement, it's so crucial to run through a tax plan with a professional. So, some of you can do it on your own, but most of you need to meet with your financial planner and actually create strategy, create a tax strategy around your income stream, around estate planning, all that kind of stuff. So if you haven't put a plan in place, make sure you do. We do offer fee-for-service financial planning. If you don't have a financial planner that does this kind of stuff, and a lot of you we talk to, you might have an investment advisor, but not someone that's putting a proper plan and structure in place for you. I'm happy to connect with you. You can go to our website, parallelwealth.com/FFS, fee-for-service. We'll put a link below. Check it out. All of the information's on there, costs, what's covered in the plan, how it works, the structure. So happy to connect on that if you need that help. So thanks for joining us in this video. We'll see you in the next one.